Hello, I'm Rachel Kelly, and welcome to our Money Matters session, part 2 on how to invest in ESG. Today's session, we're going to talk about growing your green while going green. Now, you usually find me during the week on prime time from 4 till 7 p.m. And every week on prime time, we have a session called Eco Money that airs on a Wednesday. So tonight at 6:15 p.m. And that's all about investing in ESG, from the latest products on the market to the latest regulations and trends that investors need to know about when it comes to ESG investing. Now, on the back of that, we felt that it was important, us here at Money FM, to provide a basic information when it comes to ESG investing, unlock some of those key that key lingo, greenwashing, green bonds. What are they? How are they different from regular bonds and green loans as well? So we covered a lot of those terms last week in the first session, ESG Investing 101. And today we're going to delve a little bit deeper. We're going to look at ESG funds, ESG equity funds, and ESG fixed income as well. Now, before we get rolling, just one thing to share with you is that we do have 2 sets of hydroponic mini gardens to give away to win. Just pop a question in the comment box, and the best question wins. We'll be announcing the best question halfway through the session, the first best question halfway through the session, and the second best question right at the end of the session. So you can literally grow green as well by learning about how to grow your green while going green. Okay. And don't forget to like and share this as well if you know someone that's interested in ESG investing or interested in sustainability and wants to put their money towards ESG investments, but not quite sure how to go about it. Share this link on your Facebook page with them or with your friends so that they can have a listen in as well today. So thanks again for joining us during your lunchtime. Now, before we get going and before I introduce our very special panel of guests, I've got a question for all of you. So do pop your answers in the comment box, and that is, why are you interested in ESG related products? Let us know. We'll be taking a look at your comments. Okay. So without further ado, it's now my absolute pleasure to introduce the guests that we have with us today, because we do have a stellar lineup. Really happy to welcome back Samuel Rhee, and he's the Chairman and Chief Investment Officer at Endowus. Sam, thanks so much for joining us again today. We've also got with us Sherene Ban, and she is the CEO, Singapore and Southeast Asia at JP Morgan Asset Management. And we've also got Lily Choh, and she is Singapore CEO and Head of Institutional for Asia Pacific at Schroders. Panelists, thank you so much for joining us today, and welcome to Money Matters, growing your green while going green.
Great to be here.
Oh, wonderful.
Thanks for having us here.
You all with us. Thank you. Okay, so first, to start off, to ask all of you, because you've all got different banking backgrounds, I want to ask you, what does ESG investing actually mean to you? Sam, I know that we covered this with you last week. So perhaps, Sherene, you can share with us, what does ESG investing mean to you?
Sure. So ESG investing is really about assessing how companies treat the environment, communities, employees, and other stakeholders, and really acknowledging that these factors are key to their financial success as well. So at JP Morgan Asset Management, we're active managers. We've always focused on research, and we've always considered how financial metrics would impact the performance of our investments. However, increasingly over the past decade, we realized that these ESG considerations are as important to the financial returns that we get as well.
Lily, what are your thoughts?
Yeah, let me have a go on that. So investment has always been about the dual relationship between return and risk. Well, at least for the last 1 to 2 years, we clearly saw a fundamental shift on how investors value companies. It's not no longer just about risk and return. And the third dimension of impact is added to that. So companies with impact on the environment and society, we simply can't ignore this, especially when it's negative. So with these three-dimensional views, we feel we can form a more holistic assessment of the true value of a company. And clearly, we're not alone thinking this way. In our surveys, more and more clients are telling us that they would like to align their investments with their values. So, in Schroders, as an asset manager who manage billions of assets on behalf of our clients, we are clearly in a very unique position to direct capital, shape financial returns, and the impact we have on the world. So, in simple terms, it's about profit meets purpose. It's about doing well and doing good for our clients at the same time.
I see. Now, Sam, we've got two big financial institutions joining us for this session today. What are your thoughts on the role that financial institutions play in driving growth in the ESG space?
Great to be back, Rachel. Thank you for having me again. And so great to be here with Sherene and Lily, wonderful partners of Endowus and great friends as well. So thank you for having us. I thought you were going to ask me the same question, so I was like preparing myself, and then suddenly you jumped me with another question.
Sorry to throw you in there, Sam.
No, it's so good. And financial institutions have an amazingly important role to play. I mean, they are supposed to be the stewards of capital or money, and they have a huge responsibility placed upon them. And so I think it's really important, the things that Sherene and Lily just highlighted about, doing good while doing well. I think it applies very much to all financial institutions who have a fiduciary duty to do what's in the best interest of their customers and clients, which means that, the three triple bottom line of people, purpose, and profit has to be achieved in a balanced way and sustainable way. So yeah, every institution has a role to play in different areas, but it's very critical to the future of not only our society, but the sustainability of those financial institutions themselves.
Definitely. And we've just seen conversations surrounding climate change and ESG investing grow on a daily, weekly, monthly basis over the past 18 months. So I have to ask, on the back of this, we spoke about this a little bit last week, Sam. We spoke about some research findings that showed that Singaporean investors ranked lowest in the region when it came to understanding ESG related investments and products, but amongst the highest in the region when it comes to wanting to do something, wanting to make a difference when it comes to sustainability and climate change. I'm wondering, Sherene and Lily, on the back of that, what kind of conversations have you been having with your clients, and how have those conversations shaped your ESG offerings? Perhaps, Sherene, you can start off with that.
Sure. So that's a really good point, in that one of the single biggest hurdles that we hear from our clients in these conversations is whether we would compromise on returns by investing in ESG products. Like, there is an assumption and a default that there is a trade-off in doing well and doing good, as Lily mentioned. And so that's something that really features highly in our product design and in our client and training, to ensure that people understand that there doesn't need to be a trade-off. And this is something that, we saw in the sell-off of 2020, where there was some downside protection in some of our ESG products. And then also in the rebound in the second half of last year and into this year as well, where securities with strong ESG characteristics kept pace and actually outperformed the market. So these are just some of the very important client feedback that we get in order to design and educate our clients. And I think another aspect where our client engagement has really shaped us is really in the exclusion list. We have a very strong presence in Europe. We've had a lot of conversations dating back decades to understand the nuances of various clients, which values-based exclusions to put in, and what really matters and resonates with them. And this has really allowed us to have a full spectrum of products available, including the Singapore market as well, from positive tilt products, which we'll talk about later. These maybe seek an ESG score higher than the index, or something more focused, like a carbon transition product that we've recently launched as well. So client feedback is absolutely critical. But I will also say, in addition to that, we speak a lot to regulators, including our own regulator in Singapore, just to understand and to incorporate the feedback as well.
Lily, what about you? How are your client conversations shaping what you're offering over at Schroders?
Yeah, we had multiple dialogues with clients across the region on ESG. Clearly, I think the APAC development is very different from what we see in EU. So both the large institutions accelerating adoption in sustainability, banks, especially private banks, are in the forefront of sustainable investing, and of course, insurance partners as well. The positive takeaway from all these dialogues is everyone that we spoke to has embarked on the sustainability journey, but their ESG priorities are very diverse. Let me give a few examples. Maybe 1 to 2 years ago, there was an overwhelming focus on climate and environmental issues, and there is still that focus. But now with COVID, the spotlight has clearly shifted to social issues, issues like inequality, health and wellness, human rights, and some clients have moved into the spectrum of impact investing within Asia, alignment of their priorities and goals to the UN Sustainable Development Goals. So we've been thoughtfully broadening out our range of sustainability offerings that cater to different needs and goals, moving beyond integration to sustainability, focus, and impact driven strategies. But proliferation of funds is the last thing we want. Our strategies can't be too niche or narrowly focused, and the opportunity set has to be broad and investable to give us a flexibility to navigate different market environments so we can really deliver sustainable returns to our clients over a market cycle.
You know, after last week's session, Sam, I had a question that came in, and that was, do you think that investors are interested in ESG because they really want to make a difference, or because it's a trending topic? Is it just
making
buzz
money?
Coin? So what are your thoughts on that? Do people really understand, as you mentioned, people, purpose, profit? Or is this just another buzz trend that's going around at the moment? What do you think?
I mean, obviously, I think we have to admit that it is trendy. It is trendy. It's something that resonates with people. I think it's something that people can easily, understand from a conceptual perspective. We're doing something good for the environment. We're doing something good for society. We're making the world sustainable. These are all concepts that I think any human being would agree with. I think the difficulty is in its implementation, is difficulty in actually generating a profitable methodology of investing that is sustainable. And that's where wonderful institutional investors like JP Morgan Asset Management and Schroders and Endowus come together to offer solutions for especially individual investors who do not have the access or the advice or the wherewithal to implement their beliefs or values. So it's important for financial institutions to execute for them. But yeah, I think it really at the bottom of their hearts, I think we need to generate profit for them. We need to generate sustainable returns, and the sustainability, will have a virtuous cycle. But without profit, I think it's very difficult to, incentivize people to take action.
And it could be that, Sam, you've hit the nail on the head in the sense that perhaps it's really understanding that profit and purpose can come together.
That's right.
Absolutely. We're not greenwashing this, right? I'm just kidding. Anyway, we've got some questions that have come in from the audience now, and this is an interesting one from Choh. She's asked, how is ESG calculated? How is ESG calculated? Sam, would you like to attempt? That's a very interesting and very complicated question as well when it comes to looking at ESG and understanding the different components of ESG and what ESG means to different people and how it's regulated. So Sam, from your perspective, talk us through calculating ESG or understanding ESG.
Yeah, I think that we touched upon this last week as well, but I think it starts with how we define it. So definition or taxonomy is where we begin, because there's so many different variations of how we define what ESG actually means. And then when you say calculating ESG, I think it's implying that we are kind of scoring companies or industries or sectors that are, whether they are actually ESG compliant or ESG, contributing meaningfully to sustainability or improvements in the the carbon footprint or other measures of environmental impact. So how we calculate ESG is very different as well, depending on what institution you are and what asset class you're investing in, and how you invest, whether it's an impact investment, whether it's a sustainability investment, whether it's a negative screening index fund. So there is a wide variation of calculating and investing. So I think this question is a perfect, I set the groundwork. I think it's a perfect segue into Lily and Sherene to answer into the details of how they implement it, because everybody does it slightly differently, if that's okay.
Yeah, no, definitely. Sherene, would you like to share more? Because we've got another question that's come up as well, and that's asking the role of major investment firms as people reevaluate the role of considering ESG investing. And I know perhaps both of you would kind of summarize that. So with that in mind, Sherene, would you like to share your thoughts?
So just following on from some of Sam's points on measurement and data, actually, that's actually a really crucial point as to why we're talking about it so much now. Because data availability and disclosure just weren't there before, right? And this is evolving. So now you can measure things like, CO2 emissions and carbon intensity, while maybe a decade ago, these metrics weren't available for us as active managers to incorporate into how we assess companies. And I would also say another thing that has come hand to hand or grown hand in hand with this is also been the growth in machine learning techniques, right? So I'm sure, Rachel, you've heard of Glassdoor, which is a site for employees to leave feedback.
Yes.
So just as an example, and Lily touched on social issues being really important, we've used natural language processing to create a signal to capture the employee sentiment of some of these companies, so that we're not just hearing the management side of the story, right? So all of this, is really highlighting why we're really at an inflection point, and really this is something is incorporated into how we assess the portfolios, assess the companies, and construct the portfolios as well. And it's also leading to increased disclosure by companies, increased disclosure by fund management houses, such as us as well.
Okay, great. Well, thanks so much for sharing that, Shereen. And you know what, Lily, I'm not going to ask you to answer that question, but what I am going to ask you to do is share with us your presentation. The first 20 minutes have flown by. There we go. So yes, Lily Choh, Singapore CEO and head of institutional for Asia Pacific at Schroders, is going to share with us a presentation overview now on ESG equity funds. Okay.
Oh, thank you. I'm going to address some of those questions in my presentation, so bear with me a little bit. So let me just start with an introduction of Schroders. For many of you who don't know us, we're a UK FTSE 100 company. The next slide, please. With a global assets under management of 500 billion plus. Yeah, there you go. So our clients are institutions that includes the sovereign wealth funds, central banks, pensions, insurance, as well as intermediary distributors of our products. We've got a global footprint across 37 countries in the world. And in many of these countries, we have long established investment and business presence close to where our clients are. So Singapore is our regional headquarters and also houses our regional center of excellence for sustainability, having called Singapore home for almost 45 years now to many of our clients. We have become known as a local international brand. Now, our sustainability journey started about 20 years ago. We published our first corporate governance policy in 98 and became one of the first signatories to UNPRI. In fact, just last year, we committed to the Net Zero Asset Manager Initiative as a founding member. As a leader in ESG investing, we score an A+ rating from UNPRI, the highest rating awarded, and has completed full ESG integration across all our investment desks at the end of last year. Now, the way we approach ESG is really very investment led, working in close partnership with a dedicated team of 22 ESG specialists across the globe. Our investment teams are responsible for identifying and managing ESG risks and opportunities. I think so Sherene talked a little bit about the local context, and that's extremely important in terms of data availability and the practices and the adoption of companies in Asia, which is very different from what you see in the EU. So taking into account that local context is extremely important. So next slide, please. Now, I talk a little bit about how we direct capital, which not only shapes the financial returns we achieve, but also the type of impact we have on the world. We firmly believe that investing can no longer be confined to that dual relationship between risk and return. Understanding the impact that companies have on society and the environment is crucial in determining their true cost and ultimately evaluate their profits on an impact adjusted basis. In other words, impact needs to be assessed alongside the traditional risk and return measures as a third fundamental pillar of investing. I'm going to move on very quickly to the next slide as well. Companies impact society both positively and negatively, and these impacts are not always reflected in financial statements today, but would have effect on their long-term growth prospects. From sugar taxes to carbon credits and other regulatory changes, companies are increasingly being forced to account and pay for the cost of the social and environmental externalities they create. It's very important that we factor in this cost into our analysis as they will impact bottom line and, of course, valuations. Now, that question about how do we address and measure impact that companies have in Schroders, I have that on the next slide. While there are obviously many third-party research and ratings available in the market, so next slide, please. Most tend to be backward looking, relying on company disclosures, and may not really address material ESG risks. Now, in Schroders, we strongly believe in proprietary research and conducting our own analysis, building out our tools to better understand sustainability risks and uncover opportunities. Now, in this slide, I've highlighted a few key tools. To that question, I'm going to spend a little bit of time to maybe talking a little bit of our tools as well. So on SustainX, that's an award-winning tool. It measures companies' positive and negative impacts on society, allowing us to really quantify the financial consequences of these impacts on companies' balance sheets. We also have a suite of tools focused on addressing the climate change challenge. One of them is our climate progress dashboard that really tracks the pace of progress towards the commitments made in the Paris Agreement by monitoring climate actions, indicators across political change, business, and so forth. Now, carbon VAR is what I felt was really interesting and differentiated. So we look at how a company's earnings will be impacted by the increase in carbon prices through its supply chain, giving us a more holistic view than just merely looking at the company's carbon footprint. So hopefully with all these tools, this is just a handful, but it's the key tools that our investment teams use to factor in the analysis that address the earlier questions on how we measure ESG. Now, the next step, the next slide, sorry, it summarizes how we incorporate ESG analysis into our equities process. It starts with examining the key thematic ESG trends and its implications to evaluating impact as well as active engagement with the companies and, of course, ongoing monitoring. Very much investment led with tools and analysis to support our fund managers in making better decisions, whether it is in identifying the risks that may manifest in valuations down the road or in uncovering new opportunities, especially in this shift towards a low carbon economy. What's not shown here, but increasingly important to our process, is the use of data science to enhance understanding of the ESG considerations. We comb through both structured and unstructured data. Sherene talked about Glassdoor data. We use that as well. We also use geospatial data to assess climate and physical risk, for example. Now, on slide 7, this is where we place significant emphasis on engagement with companies we invest in. We think about active ownership, active engagement using two lenses. Well, the first obviously is dialogue with the companies, which is the fundamental of our approach. We proactively identify trends and sometimes regulatory risks and engage with these companies to see how they're responding to these challenges. For instance, 2 to 3 years before the sugar tax came into play in the UK, we started engaging with the beverage companies to understand how they're evolving their product line in response to ESG related regulatory change and the impact to their market share and bottom line. These dialogues help our investment team uncover more insights to the companies we invest in. In fact, just last year, we had over 2,000 engagements with companies globally. We also vote every resolution aligned to our ESG policy. So last year we voted on 69,000 resolutions. Now we're not shy to vote against management if we feel they're not acting in the interest of our clients. In 2020, 47% of our votes were against management. It is a huge undertaking, but it is critical that we hold the company we invest in to account. Now, the next slide, please. In our survey, more and more clients are indicating that they like to align their investments with their values. I'm showing you our global transformation range here. It offers access to sustainability-focused thematic funds, providing exposure to powerful multi-year secular themes that are really transforming, well, our planet in the most post-pandemic world. And many of these funds are already available in Singapore in anticipation of growing demand. And we will be actually registering and applying for inclusion into the CPF scheme to broaden out the sustainable options for CPF members looking to enhance their retirement savings and doing good at the same time. Now, I'm going to just end with this slide, my last slide, please. It is two of these funds, Global Sustainable Growth and Global Climate Change Strategies, that are already available in the market. So both are high conviction global equity strategies managed by our global equities team. Now, the Sustainable Growth strategy gives you a very broad exposure to sustainable business companies that creates value through its relationship with stakeholders. The climate change strategy exploits opportunities arising from the transition to the low carbon economy. Around 70% of global emissions are now covered by a net zero policy, and we feel the next 5 years are expected to be a crucial inflection point in this transition, thereby creating unprecedented opportunities. I think I've used up my time. I'm going to stop here and see if Jasmine has got questions for me.
Yeah, there we go. I was on mute. Apologies for that. Was listening to you so intensely, that's why. Anyway, so Lily, thanks for that presentation. I think you've answered so many of the questions that have come in from our viewers, taking a look at our comments. Wow, we've had quite a few questions come in fast and furious over the course of those 10 minutes as well. I'm going to get to answering some of those in a minute, but just a reminder, if you know somebody, if you're watching this and you know someone that's interested to invest in ESG, they want to find out a little bit more, like and share this video. They can watch it live now, or they can watch it again at a later date. This will be posted on the Money FM site after the session has been completed today. Now to the important task of awarding the first winner of our hydroponics garden, so you can grow your own greens at home while you're thinking about growing your green by going green. And it's really difficult. There are so many questions that have come in, really, really great questions as well. So let's just take a quick look. There was one in particular that we answered earlier on that I felt that we should put in for the first winner. Where has it gone? Here she is. Here we go. Jinlin, congratulations. You have won the first hydroponic garden giveaway for today's session. Our team will be in touch with you after the session to arrange the logistics of getting it through to you. Thank you very much for your question. Okay, now on to answer more of the questions that have come in before we get into Sherene's wonderful presentation in about 5 minutes' time. Yes, we are halfway through the session. Where have the first 30 minutes gone? Okay, so let's start off. Wow. So let's start off and take a look at, does ESG help to improve financial performance? That's one question that we've got in here. We've also got another one that talks about, here we go, is ESG important for banks and financial institutions as well? So perhaps we can start off with this first one. I know, Lily, you've mentioned this briefly. Sherene, you alluded to this earlier as well. And Sam, we spoke in some depth about this last week as well, but I think it's just important to cover this again. Does ESG help to improve financial performance? Perhaps, Sam, you can start off and take the lead here.
Yeah, great. I think we can approach it from two different angles. One is, academic research and studies about, long-term returns and how they've done. especially compared to the risk that you're taking. So what we call risk-adjusted returns. Most of the academic research and empirical evidence suggests that long-term returns for ESG investing provides better risk-adjusted returns. Now, from a realistic perspective, in Singapore, investing in ESG is not easy. And that's why we work with great partners like, Schroders and JP to develop the retail investment portfolios for ESG sustainable investments at Endowus. And that's really important that you actually find globally diversified, low-cost solutions for yourselves, which will lead to better outcomes. It's really important to actively look for low-cost solutions, which will improve your chances of success. You should activate, globally diversified solutions because it minimizes risk. So taking this kind of balanced approach is really important. And, I believe that personally, and evidence suggests that you can generate better returns over the long term.
Okay, and that leads beautifully into this next question that we've got, and that's how risky is it to invest in ESG? That question coming in from Alden Pei. Thanks, Alden, for that. How risky is it to invest in ESG? Sam?
Back to me. I muted myself, thinking that it wasn't coming back to me. How risky is it? It depends. It depends on what you invest in, who you invest with. Obviously, you want to go with money managers who have done this for a long time. You would never trust a doctor who has just been licensed or is still studying medicine, right? You need to go with somebody who's done this before, who's very experienced, who knows what they're doing. And these are the managers and these are the partners that know what they're doing. We've gone through the global fund managers list. We've gone through every fund that's in the ESG sustainable space, and we have selected the best managers. And within them, obviously, there are differing outcomes in terms of the funds that they manage as well. So we have to do due diligence on the individual fund level to see, whether they're doing what they say, first of all, and are they generating sustainable returns? Are they taking inordinate risk to achieve those good outcomes, or are they taking, decent amount of risk, or are they managing risk really well? All of these things need to be considered, and that's where good advisors come in handy. And that's what we do. Is we do a lot of research, we screen for the best funds, we work with the best managers, and if you do that, then you're reducing risk. Because if you go out there and you just selecting the best performing fund, but you don't know what they're actually investing in, how they're investing, then that's going to be risky. So it really depends on where you invest, who you invest with. But overall, if you find good managers investing in a good way, I think the risk can be managed really well.
Rachel, if I may just share a thought.
Please, Lily.
Yes, clearly we believe it's possible to make profit and do good at the same time. So sustainable companies are, in our view, in a more resilient position to grow over the longer term and deliver returns. And not taking into account environmental or social issues, to us, is a very big risk to any portfolio. So today, investors are now making greater connections between the impact that companies have within society and their financial performance. So hopefully that gives you another thought behind that as an answer to that question.
Definitely.
Yeah.
Sherene, anything to add?
Actually, just to weigh in as well on the fixed income side, I think what Sam said was his validation of us in terms of manager selection, which is a great testament. So thank you for that. However, further on to what Lily said on the equity side, I just want to add on to a point on the fixed income side as well, where actually consideration of ESG risk actually have been shown to help to avoid defaults or downgrades, right? And I think that just offers some degree of downside protection to fixed income portfolios as well. And that's key, right? Because in fixed income, your upside is generally pretty much capped. You're looking at risk mitigation. And what we've actually seen is considering these factors helps to have a more resilient portfolio and actually improve the risk reward profile. And we saw this, it was very apparent last year, especially in the first quarter when things were selling off. And we saw this manifested in real life performance. So I think that's a great validation of the impact that, looking at ESG characteristics have in terms of the investment process.
So in a way,
a wonderful segue into Sherene's presentation. Yes, sorry, Sam.
No, I was just going to summarize. It's actually risky not to do ESG, right? That's the bottom line.
I see what you did there. Okay. And I've got a question for all of you as well. Sherene's just mentioned ESG fixed income. For all of those listening in, are you more interested in ESG equity funds or ESG fixed income funds? Do you understand the difference between the two? Let us know. Put your comments in the comments section. Now, without further ado, Sherene's given us a lovely warm up into ESG fixed income funds. Sherene, CEO, Singapore and Southeast Asia, JP Morgan Asset Management. She's going to give us a quick overview and a presentation now. Sherene, I will hand it over to you.
Great. Well, thanks, everyone, for letting me have this exciting opportunity to discuss sustainable investing in the fixed income space and to introduce our Global Bond Opportunities Fund with you. Even though this specific strategy was only launched at the end of 2019, the journey of JP Morgan Asset Management in the sustainable space, if we look on the next slide, was really long in the making. And you can see from this slide, some of our values-based mandates actually date back to the 70s, right? And then moving from left to right, and just to call this out, we really started to integrate ESG considerations formally into our investment process in 2016. And we are approaching full integration for all our active strategies. We also have a dedicated sustainable investing team led by Jennifer Wu. And we make our voice heard in a variety of ways, such as in stewardship, by collaborating with other investors in joint engagements, such as Climate Action 100+, and the 30% Club. So now let me move on, if we look at the next slide, to introduce our Global Bond Opportunity Strategy, which you can access via Endowus. So what is it? It is essentially a strategy that provides three things. One, best ideas, high conviction exposure in a benchmark agnostic fashion. Secondly, it does this across the entire fixed income market and thus is very diversified. So it does have a good role in your portfolios in terms of diversification. And third is dynamic with the ability to flexibly shift depending on market conditions. All of this with an explicit focus on sustainability. So this really builds on our suite of existing unconstrained fixed income strategies, which we've been doing in JP Morgan Asset Management for a while. So we're very much leveraging the same team, the same process. This strategy seeks to achieve total return with a 5 to 10% volatility target. Let's move on to the next slide. When I say explicit focus on sustainability, what does that mean? This slide really outlines the three pillars of sustainability for us. Firstly, ESG integration. We already mentioned our entire global fixed income team has been determined fully ESG integrated by our dedicated sustainable investing team. Now, this really starts with a common research platform of analysts that conduct proprietary research focused on various inputs. They range from financial metrics, which we've been doing for a while, but it also takes into account ESG considerations. This is then embedded into our portfolio construction stage, as well as our risk oversight. So really integrated in the full spectrum of how we look at portfolios. Secondly, we look at exclusions. Now, we apply both norms and values-based exclusions, and we incorporate a lot of input from clients, as we discuss, and also regulators. So norms-based exclusions means we don't invest in issuers that violate international standards, for example, the UN Global Compact and so on. And values-based exclusions refers to the fact that we don't invest in sectors deemed unsustainable, for example, weapons, right? And then lastly, the third pillar is really that of positive tilt. That means we put in a holistic lens in terms of portfolio construction to ensure that our sustainability profile of the portfolio is greater than that of the overall investment universe. Now, what this means for us as active managers, it could mean favoring issuers with better sustainability characteristics and avoiding those with the worst. And one way in which we may participate in this is via the growing trend for bond issuance in green and social bonds. You've probably seen a lot of news on this already, and we've seen a 30% rise in supply in 2020 for this, and this is accelerating into 2021. Now, the key thing that's crucial when we look at green and social blue bonds is that we want to stress that as part of our total return goal, we need to actively assess these environmental, social, and governance characteristics. But we also want to ensure no greenwashing, which is a subject, Rachel, you touched on. And importantly for our clients, because we have this total return focus, we need to focus on valuations. We need to ensure that the yields we get on these instruments are adequate. And some of examples of this which have passed the test include a bond that we recently purchased in Coca-Cola Mexico, which really use the proceeds of these bonds to be directed to better water management. So it was one example of some of the things that we've bought directed to a specific environmental purpose. And this is something we're happy to, these are examples of securities that we're happy to invest in. Now, the result of all of this is really to keep the ESG score of the fund greater than that of the fixed income universe. Now, let's move on to the next slide. We talked about sustainability, which is very important, but we also need to look at the overall portfolio to see what we're investing in. I know that this was the best ideas, diversified, dynamic fund. And this slide just seeks to highlight what we invest in, how we shift the portfolio. For example, you can see high yield moving in a range of 15 to 50%, duration, EM exposure shifting a fair bit based on our analysis. And the goal is really to deliver the total returns to our clients. So if we move on to the final slide, I just wanted to summarize that Global Bond Opportunity Sustainable is a one-stop shop in the fixed income space. The fund has been really recognized by our clients. We launched at the end of 2019, and we're approaching $1 billion in assets. We're at 950 million now, so in just less than 2 years after launching. And this is one of the industry's largest unconstrained sustainable fixed income funds. So environmentally, what this also means is that for 1 million of revenue generated by companies in the portfolio, the Global Bond Opportunity Sustainable strategy emits about 80% less carbon than that of the overall global fixed income universe. So what this implies, and I hope with this short presentation, this has convinced you, is that we've shown that we can really both do well financially as well as do good for the environment and for social reasons. So this is, the strategy that we have. You can access it via Endowus, and we're just really excited to bring this into the Singapore space, and it is registered in Singapore as well. Back to you, Rachel.
So much for sharing all of those insights with us as well. Quick question for you, as you mentioned, the possibility of doing good and making profits. But what more do you think then can be done to encourage investors to look more closely at these types of investments?
Sure. I think one major thing is that we've all seen how equity markets have performed really strongly last year as well as this year. So we're still in the midst of a very strong equity rally, which we think is really positive for all of us. However, over time, markets don't go up in a straight line. Clients will need diversified portfolios and will look at fixed income. And what you would need then when you look at fixed income, especially with interest rates where they are, what you really want is an unconstrained fixed income manager. You want someone who can go and find the best opportunities across the fixed income universe. And then you can do that with a sustainable focus as well. So I think that's going to be the real catalyst that brings people into the fixed income sustainable market. Just people acknowledging that it's not just about equities. We have great equity products, like Lily mentioned, but it's also about how we look at the portfolio level. What is the role of fixed income in the portfolio? And then having that sustainable, tilt to it as well.
I see. And just speaking about equities as well for a minute, Lily, I'm just curious, how do you actively engage with firms that you invest in to advocate ESG and sustainability initiatives?
Yep. Thanks for that question. So active ownership and engagement are really key components of our sustainability approach. I mentioned earlier about using that two lenses. So having active dialogues with companies, more than 2,000 companies we've engaged last year. And also I think in terms of active voting, so we're not shy in voting against management. So if they're not acting in the best interest of our companies, of our clients, for instance. And I think this is really important. It may take a long-term process, best to drive change. But if all of us in the sense of collective action drive that engagement, take ownership, and make that change, I think it's going to be very effective and powerful going forward.
Wonderful. Okay, so I'm just going to have a quick look at some of the questions that have come in as well. We've got a question here from Celestine Choh. She's asked any red flags we should look out for when it comes to ESG investment. We've heard from Lily and Sherene. Sam, would you like to share what do you look out for when you're assessing some of these funds that are available to bring them to clients here in Singapore? Any red flags that investors should also be aware of and look out for as well?
Yeah, I think there's many, but the reason we work with these partners is because they are experts at what they do. I alluded to that earlier, and just to make it clear that we gave Sherene a role of fixed income and Lily as equities, but JP Morgan has wonderful equity products and Schroders has wonderful fixed income products. They're a global manager of assets with a whole suite of products that we review and look at. So these capabilities exist broadly, and so the first thing we look at is scale. You need to be at a certain scale with capabilities, with human resources, with a lot of experience in investing in this space to do it well. So I think some of the red flags we see is new setups, people who've only just set up an entity because they're jumping on the ESG bandwagon. Or they say one thing, but if you look at the numbers and look at the way they manage their money and they invest, it's actually quite different. So the philosophy or the process of investing is not quite what we think it is. And the third thing is if it's a fund that has had, I'm just focusing very much on the retail space and some of the things that you can pick out. If it's a fund that's been around, but they recently changed their name from an Asian fund to an Asian sustainable fund, then it's a bit of a red flag for us. They could be doing it in the right way. They could be. It's not that it's not always the case. But if they change names on the fund, then largely maybe they're just integrating ESG, but they're not a dedicated ESG.
They're just hopping on the green bandwagon. Is that what you're saying?
Maybe. So, so these are some not red flags, but things that you need to question, and you need to do your due diligence because. As Sherene and Lily have highlighted, this is not a space where passive investing is easy. It's an active space. So you need to actively, have a process in selecting the best companies to invest in, have an active process of engaging with these companies to improve outcomes, and have an active process to generate alpha above the benchmark index that you're benchmarking yourself against. So it's an active process. And so that's why it's even more important to do the proper due diligence.
And that said, when it comes to doing the proper due diligence, you've highlighted some of the risks there, Sam, but looking at some of the portfolios for funds, I mean, not just ESG funds, some of these can go into, about 1,000 pages. So from an investor's perspective, and perhaps some of this is in, lingo that may not be so comprehensible to everybody if you're not in the financial industry. So what are some of the key things that perhaps investors should look out for when it comes to portfolios or understanding different funds and the potential?
So it's difficult because I think the fund managers they have it tough because those prospectus are required as a regulatory requirement, right? And you have to have product highlight sheets and key information disclosures. Some companies produce, monthly fact sheets, which are much more condensed versions that give you an update. So these documentations are really important. But what's also really good is, I highlighted this in our last session, is these fund managers, including Schroders and JP Morgan, have wonderful resources on their websites, which, they provide openly and freely research that's available for the retail audience so they can educate themselves better. But also, for example, Endowus, which is a digital advisor, we do our work and our due diligence, and we, publish for every fund we onboard and we put into a portfolio, we write up a fund rationale, why we selected the fund, why we think this fund is the best in class, why this fund has achieved this outcome, and try to give as much information and disclosure. And that's really important, especially for retail investors, and make it, accessible, make it, understandable easily. So the fund rationales from Endowus, coupled with the monthly fact sheets and the basic information provided by the fund managers, and then also research, both at the fund manager level, at the Endowus level. Financial education is so important and critical to us. So we have a, bevy of resources written, our webinars. You've done a fantastic job, I have to say. You were one of the early ones with Eco Money. Like, how long ago was that? About a year and a half ago when you started that. I think these are wonderful resources that's available for retail investors, and they should take advantage of that.
Interesting fact, Sam actually had a show called Eco Ventures a decade ago, but at that point in time, no one was really interested. So there you go.
Things take time.
How times have changed. But yes, let's take another look at some more of these questions, Lily and Sherene, and let's bring you two back in here. Now, we spoke about this a little bit earlier, but this question keeps popping up on the feed, and that's: what metrics are used to measure the ESG performance in clients' investments by financial institutions? And I think that really speaks to understanding how ESG impacts an investment, this whole conversation we've been having around purpose and profits and how that comes together. Perhaps, Sherene, I know you mentioned this a little bit during your presentation, but could you just give us a recap there? How do you measure the performance of ESG when you're looking at a fixed income?
So I think let's break down the E, the S, and the G.
Mm-hmm.
Arguably, the G characteristics, which is governance, is somewhat easier just because of data availability, right? It's things such as capital allocation and so on. So we can use those inputs into how we assess companies on that metric. When we look at the E, it's evolved, right? So it's much more easily available to look at, water emissions, carbon emissions, water usage, access to water supply. So it's much easier now to get access to some of this data. And where we don't have self-disclosed data, we can perhaps use some machine learning techniques and various other means to be able to assess these companies and in terms of how they stack relative to peers and on an absolute basis. The S part is slightly harder. We have to do a lot more due diligence because with the S, or the social parts, yes, you can go and count how many women are on boards and what are the various diversity metrics. But understanding the supply chains for companies, especially companies that have then outsourced a significant part of their supply chains, and understanding the labor, their labor practices and so on, takes a little bit more work. And that's why it just still does go back to active management, right? In terms of, do you know the companies? Do you know what their labor practices are? Do you know how much they've outsourced? And then you can't just stop there and say, well, they don't employ any labor because they've outsourced all their manufacturing, for example. So it's really understanding the entire chain in terms of supply chain, labor chain, and so on. And these are the hard facts that then go into how we analyze the companies. So that's on the input side. And then on the output side, I will say that there are a lot of third-party providers, MSCI and so on, that do look at the portfolios and do rate them. I think they are a industry-used rating system, and it's good as a means to compare various strategies. They're by no means perfect, but nothing is. But that is a industry-wide metric that is available by third-party agencies. So I'll pause here and pass it over to Lily.
Thanks, Sherene. Thanks. Go ahead, Lily.
Thanks, Sherene. I think Sherene made really good points. So on ESG equities, I think it's mainly that you can kind of it's really important on disclosures and reporting. I guess relative to the respective benchmarks. In Schroders, we do use third-party ratings, but we also use and emphasize a lot on our own tools. So I mentioned about SustainX. That's where we really can quantify the social impact, whether it's positive or negative, and we could kind of disclose that relative to the benchmark and show a better score and green content. I think that's really important. I think disclosure and reporting, because if you invest in an ESG fund and you don't know what kind of impact it makes on the environment, on the society, that's really a big question mark. And that's why there's so many questions coming through. So hopefully, I think through this session, we've kind of addressed it.
And just one last question from the audience. I'm mindful of time as we head into the last 4 minutes. We've got this question that's come in from Melvin Mark, and it's, do the different ESG investment products cater to different investment durations, please? And earlier on, we spoke about how ESG-related products have been tracking in comparison to the broader market, but we also shared that this is by no means an indication, perhaps, of the longer-term trend when it comes to ESG investing. Sam, anything you'd like to share there in terms of investment timeline and different products available on the market when it comes to ESG investing?
Yeah, I think that when you are investing in this sustainable space, it is not so different from your general investing, methodologies and practices. I think as individual investors, when we're not professional investors, we should be investing for the long term, because long term, both equities and fixed income have generated a certain level of returns that we expect from the asset class. So being long term in nature is really important. We can take advantage of the traditional financial expertise and things that help generate better returns, like global diversification, which diversifies away some risk and improves returns adjusted for risk. We can take advantage of things like, lowering cost. So these basic tenets of success in investing apply to ESG as well. So it's not like that ESG is so different that we need to do a separate way of investing. But what ESG provides for us is better risk-adjusted returns. It gives us an ability to reflect our values in investing so that we can, improve society and the environment. And then finally, I think what's important for individual investors is really approaching it from a holistic perspective. It really depends on your personal circumstances. What is the risk appetite you have? And then do you want to invest in the equities portion or the fixed income portion or different asset classes? So it's a very personal process. And so I think you need to assess what your needs are and your values are before you start investing.
Wonderful. Well, thank you all so much for your insightful sharing, presentation, comments, responses to the questions, and patience with the questions that we've asked all of you today. Once again, we have been joined by Samuel Rhee. He is Chairman and Chief Investment Officer at Endowus. Sherene Ban, CEO Singapore Southeast Asia at JP Morgan Asset Management. Lily Choh, Singapore CEO and Head of Institutional for Asia Pacific at Schroders. Thank you all again. But before we let you go, we've got to award that last hydroponic garden. Now, I'm not going to award this based on best question, just sheer volume of questions, because Sherang, I don't know which of your questions to choose. You've asked so many fantastic questions that you are the recipient of the last giveaway for today. I'm going to pop one of your questions up on here, but taking a look, I think you've asked over 10 questions. So thank you so much for being so engaged today. And we hope that we've addressed most of your questions. For those of you whose questions we have not answered, we will try to do so after the session has ended. But don't forget, you can also tune into Eco Money tonight, where we'll have much, much, much more on sustainability and investing. That's up at 6:15 p.m. tonight. So everybody, thank you yet again for spending your lunch hour with us. We hope you've enjoyed it and you found it informative. And thank you again to all our wonderful special guests today. It's been an absolute honor to chat with you and for your time today. Thank you very much.
Thank you.
Thank you.
Thank you, everyone.
Thank you.
Thank you. Bye-bye.